let us begin. And before we begin, just to remind everyone, feel free to leave your questions in the Q&A tab, and we will get to them right after we end the session. Thank you. Okay, so first up, we have Raffles Medical Group for their second half results of 2020. So as we will be upgrading to an accumulate call with a revised target price of $1.18. Right now, for Raffles Medical, their second half results, we see that they have saw good revenue increase of 9% year on year in the entire year of financial year 2020. And in terms of healthcare services, especially, we saw that it is up 18% year on year, and this is led by the fact that there was a 20% year on year increase in the second half from 6% in the first half. What we saw was that what we know is that Raffles Medical in the first half of the year when COVID first hit, they were taking part with government initiatives such as swabbing the foreign worker dormitories as well as to conducting air border screening. So in the second half, they actually expanded services to include PCR and serology testing. So this helped to lift some of the healthcare services revenues. And in terms of hospital services, which is their second segment, we saw that it is stable, up 1% year on year. And this was even with the fact that we have a loss of foreign patients from all the border closures. What Raffles Medical noted was that after the circuit breaker, there was actually new patients that actually went to the hospital. Not sure whether this is a pent-up demand, but because they are new patients, hopefully, and this is a sustainable increase in new patients. And with global vaccination programs rolling out of the global vaccination programs, it will ease travel borders, and foreign patients are expected to slowly recover. Even as of now, some foreign patients with chronic diseases, if they have to come to Singapore for their surgeries or treatment, they can actually apply to MOH for approval on a case-by-case basis. But of course, definitely, these standards are starting to relax a little bit, and this will help to boost some of the hospital services revenue for Raffles Medical. In terms of the negative, we saw that Raffles Medical operating expenses actually rose higher, especially on the higher staff costs. So staff costs increased 9.3% year on year, mostly because of the higher manpower intensity of the new services that they have rolled out in 2020 itself. And of course, a lot of part-time workers that they have to hire. And also, we know that with the government sector increasing wages for nurses as well, they will have to peg their wages slightly higher, as in higher on for the healthcare workers as well. And this will be this will see them incurring higher expenses in 2021 and moving forward. And also, if you take a look at the table on the left-hand side under other income, we saw that Raffles Medical actually received $28 million in job support scheme for 2020, which helped to offset the rising pressure in income for 2020. However, moving forward, as this JSS job support scheme tapers off in 2021, they will face more cost pressures. And also, Raffles Hospital Shanghai is due to open this year, and this will result in higher costs as well. So in terms of outlook, we take a look at China operations. This is always at the back of everyone's head for those who are watching Raffles Medical. In terms of Chongqing, they actually saw better operations in 2020 compared to 2019, despite the challenging environment. And I think this is also helped by the fact that China recovered from the COVID-19 situation pretty fast. And so they are expecting that Chongqing Hospital will be breaking even in 2021. For the Raffles Hospital Beijing, it was upgraded from a clinic, and this will see the hospital itself support inpatient services and minimally invasive surgeries, which will boost profitability of the Beijing hospital. And Shanghai, like I was mentioning, the opening was delayed. Previously, they were slated to be open by end of 2020, and now they are expected to open probably in the middle of the year. And we expect narrower EBITDA losses for the new Shanghai Shanghai Hospital compared to the Chongqing Hospital due to Shanghai's demographics itself. Shanghai has a higher expat ratio, and as a result, we expect to see higher demand for private healthcare services, which are a little bit costlier in China. In terms of recommendation, we are upgrading to an accumulate call with a higher target price of $1.18. And what we see is that they will have a healthy revenue growth moving forward, although it will be weighed by some of the cost pressures as well due to Shanghai Hospital, Shanghai's hospital opening, as well as other expenses related to the expanded business that they will be coming up with. In terms of our DCF model, we actually roll forward to the FY23 cash flows, where we expect Chongqing to be profitable and Shanghai will be breaking even in the year 2023. And that's it for Raffles Medical. Now moving over to talk about OCBC results for the fourth quarter. In terms of OCBC, we saw that their results, the positive thing, first of all, is that they have a stable interest margins. Fourth quarter net interest income actually grew 1% year on year to a 2 basis point improvement in net interest margins from 1.54% to 1.56%. However, we also see that there's a limited room for asset repricing. That's why the bank also guided for slightly lower net interest margins in the year of 2021 to come in at about 1.5 to 1.55%. We know that although loans growth is slated to recover in the year 2021 with the economic conditions improving, however, across the board, the banks are saying that it is hard for them to price these loans, the new loans that are coming in at a higher margin. Secondly, we also see that they have low GP. Total allowance for the quarter came in at $285 million, which consists only of $48 million in general provisions. And if we take a look at the previous 3 quarters that they actually announced higher credit costs, most of them are going into GP. So this is a sign that the end of the credit crisis is here, and they do not need to cater for more GP allowances moving forward. Loans under moratorium also improved from 9% of their total loan book to drop to 2% of their total loan book, which is about $5 billion by January 2021. And with this, the good buffer of their reserves that they have built up in 2020 will be sufficient to tide over 2021 and to see the economic recovery. And lastly, for the positives, they are in a very strong capital position. CET1 ratio actually improved from 14.4% to 15.2% quarter on quarter. So this is a huge jump quarter on quarter, but a lot of it was actually expected because previously they were already mentioning for Wing Hang Bank, they have some of their migration into internal ratings, which will see some risk-weighted assets to be reduced. And this Wing Hang Bank reclassification of their assets, risk-weighted assets itself, has contributed to 0.5% of that improvement in the CET1 ratio. So for them being in a strong capital position, we are expecting them to be able to resume to their pre-COVID-19 level of dividend payout, which is 0.56 56 cents dividend per 56 cents per share once MAS lift their dividend restrictions. And also they also are not going to put any discount. Previously they were offering a 10% discount on their scrip dividend. However, for this half dividends, they are not having any discount, which shows that they do not need to build up any more capital for moving forward. In terms of the negative, I think something to take note of is their weaker loans growth compared to their peers. Loans actually grew only 1% year on year from 264 billion to 267 billion amidst the challenging environment. However, like I was mentioning, the better macroeconomic conditions will support a healthier loans growth of about a mid-single digit in 2021. In terms of outlook, economic recovery is expected to accelerate in the second half of 2021. The bank is expecting improved consumer confidence to lift business sentiments. And existing geopolitical tensions are not expected to worsen from where it is at the current point, which will benefit business flows within the region. So this will help to lift fee income as well as loans growth. In terms of recommendation, we are upgrading to a buy call with a higher target price of $13.65. So earnings for 2021 was revised upwards by 19% on a lower credit cost and better wealth management and insurance business contribution. So our return on equity, we also upgraded it to 9%, which from the 7.5% that we saw in 2020, partially due to the fact that they have a higher equity base because of their their strong capital position, which kind of makes their efficiency much lesser in terms of ROE. But as they resume their dividend payout, it will help to improve their ROE as well. And so we also changed some parameters to our model, and so we are pegging the target price to 1.19 times of the 2021 price to book value. And with that, this is it for OCBC results. I'll now hand the time over to Terence, who will be talking about Sembcorp Industries results.
Thanks, Wee Kwang, and good morning, everyone. Sembcorp Industries reported their full year 20 results, and we present a summary of this in our current slide. For full year 2020, their net profit before exceptional items of 301 million came ahead of our loss estimate of 147 million. The variance came from better than expected energy revenue. You can see the breakdown on the table on your left. You can see the breakdown of the revenue here. So for second half, energy revenue came in 9% lower for second half compared to the nearly 20% drop in the first half 2020 due to the fall in oil prices and disruption to demand caused by national lockdowns. So energy demand recovered slightly, especially more pronounced in the fourth quarter of 2020. And prices also improved in their key operating markets in Singapore, China, and India. There are no near-term impairments expected or further impairments expected for the group for 2021. They also gave an update on their Myanmar operations, and there are no, based on what they know now, there are no disruptions to the plant, and the plant is still running on full capacity. For full year 2021, we expect earnings of about $30 million to be at risk. This is due to the potential exit of a major customer on Jurong Island and a one-year overhaul of a customer's facilities in the UK. We raised our target price to $1.77 as we pegged Sembcorp Industries to 0.85 times FY21 price to book value, which is closer to their 10-year historical average mean. But we downgrade our core from buy to accumulate as the positives are mostly priced into the stock. For our next counter, we cover Koufu Group, who also reported their second half 2020 results. Yep. So for this slide, you can see that full year 20 revenue came in at 99% of our estimates due to consumption recovery happening just slower than what we expected. From this table on the left, you can see that for outlet and mall management, it actually declined by 7% on a half-on-half basis due to decrease in fixed and variable rent income, as outlets located at tourist hotspots near offices and tertiary institutions continue to face lower footfalls. At F&B retail, this saw a very strong recovery in the second half of 2020, mainly due to contributions from newly acquired Delhi Asia Group and a partial recovery in sales at their F&B stores and kiosks. Overall, we see we forecast a 30% improvement in footfall in Singapore and Macau in second half 2020, and we expect this to continue in 2021 as well. One downside though is the expected TOP of their integrated facility is delayed again. This is the second delay, and this time to the first quarter of 2021 due to construction delays. The group expect that the TOP will be completed first quarter, and they will move into the integrated facility and be operational in the second quarter of 2021. We also got an update that the group is currently in the midst of sourcing for buyers for their 2 existing central kitchens, and we see the announcement of the sale of their 2 existing central kitchen as a potential catalyst for the stock because of a potential distribution of the special dividend. All in all, we downgrade our buy rating to accumulate with a lower target price of 68 cents as we benchmark our valuation to 18.5 times FY21 PE. This is unchanged from previously, but the lower TP is a result of our lower revenue estimates for FY21 and FY22 by 6.5% and 6.2% respectively. Consequently, profit for FY21 and FY22 is reduced by 11.5% and 10.4% respectively from negative operating leverage and the delay in completion of the integrated facility. That's all for me. I'll now hand over to Sia Engineering, who will cover IREIT Global.
Okay, thanks, Terence. Next, please. Yeah, so next we have IREIT's full year 20 update. So starting with the positives, firstly, the results were better than expected. IREIT's rental collection rate exceeded 99% throughout full year 20, and revenue and NPI were up by 7.2% and 7.3% year-on-year, following the consolidation of its Spanish properties after the acquisition on 22nd October. Secondly, portfolio metrics remain stable. Portfolio occupancy remained high at 95.8%, although 0.5% down from a quarter ago. This is due to 2 tenants exercising their break option at Delta Nova 4. Full year 21 lease breaks and expiries are also minimal at 3.7% and 3.3% of gross rental income. And lastly, portfolio valuation improved by 1.2% even amid COVID. This is led by higher portfolio valuation from the German portfolio, anchored by high German portfolio occupancy and blue chip tenants, offset by Spanish portfolio due to longer vacancy assumptions. For the negative, about 32.5% of the leases by gross rental income will be due for lease breaks in FY22. That said, 5% of the lease breaks are attributable to DRB for its lease at Berlin campus due in June 2022. We believe that DRB is likely to keep its lease given that the rental rates for this property is attractive. DRB recently leased a new building adjacent to Berlin campus for more than double of Berlin campus passing rents. The other properties that are up for lease breaks or expiries are IREIT's Darmstadt and Münster campus, which are leased by Deutsche Telekom. IREIT has started to engage them for early renewals. In terms of outlook, with lockdown extensions in place in a number of economies, a recovery in the European real estate market remains uncertain. To date, physical occupancies in its portfolio amount to about 30%. After the rights issue in 4Q20, leverage improved to 35%. In addition, all of IREIT's borrowings are only due to mature in 2026. We believe that this provides IREIT with greater flexibility to pursue M&A growth opportunities, and as of date, is looking at office, retail, and logistic assets in Europe, particularly in countries where PhillipCapital, IREIT sponsor, has a foothold in, such as France, Italy, and the Netherlands. For the last point, to provide more options to its unit holders, IREIT is exploring the possibility of implementing dual currency trading. Although its Sing dollar trading liquidity may be compromised, we believe that dual currency trading will help to attract European investors that are looking for exposure to a pure Western Europe office portfolio. IREIT is also considering to change its distribution currency from Sing dollars to Euro, and if implemented, IREIT will not need to hedge future distributions. This is more efficient in our view, as IREIT can focus purely on operational metrics. So just to conclude, you maintain accumulate with a higher TP of 70 cents. FY21 eDPU has been raised by 7% due to better operational performance. The current price implies a dividend yield of 7.3% and a total return of 14.2%. So this is all from me. I'll pass my time to Paul for Sheng Siong.
Okay, thanks, Jovi. I'll just run through Sheng Siong's fourth quarter results. The title demand still above trend is basically the current situation. Demand for groceries remain elevated, despite us entering to phase 3 of the reopening. Next slide. In terms of the positives of the results, the first will be the revenues. As you can see from the red bar, sorry if it's a bit small. In the red bar, you can see the revenue in the fourth quarter, December quarter, it rose about almost 28%, rose about 29%. And if you focus on why there was such a strong growth, you look at the SSG, which is basically same-store sales growth, basically the sales of the matured stores, which is older than 2 years. You can see that the growth for the stores were up 18%. And if you compare to a year ago, fourth quarter, same store, it's not on the table, but a year ago was 1.8. So you can see the stellar growth. So same store sales is growing about 10 times the usual historical growth rate. The other reason for the strong revenue growth is the new stores, which added about 10 percentage points. Another positive of the results will be the record cash. It's not on the table, but record cash. So the net cash as of December 20 ballooned to 200 million. Prior to, in pre-COVID, the net cash at Sheng Siong usually around about 80 plus, at most 90, but now it's more than doubled to 200 plus. The other reason is, of course, the good results and also the strong free cash flow. So for the full year, they raised their dividends by 83% to maintain a 70% kind of payout. In terms of the negatives, the negative is basically fewer stores. And this is important. I think as we mentioned, new stores usually contribute 10 percentage points of growth. So, but this time around, because of the flip side of the pandemic is that HDB temporarily suspended new stores. So for the whole year, there's only 2 new stores. But any slowdown in new stores will be temporary. There's still a pipeline of about 20 stores expected in the next 2 to 3 years. So I know Sheng Siong has about 60 or over storefront. So this can still sustain growth. I mean, if they can do 2 or 3 or even or at least 4 to 5 stores, but next year will definitely be weaker than the 5 stores that they kind of opened in 2020. The other part was a spike in admin expenses. I think we know why they gave this stellar bonus. In terms of the outlook, for us, how when we're modeling, because of the whole pandemic situation and revenue is elevated, we very hard to provide any trend growth. So for what we did was, in 2020, the revenue per square feet, let's say about 2004. So we're just modeling it at 2001, and this is like 10% higher than the pre-COVID levels. Again, revenue this year is going to be a bit challenging because we're not sure. It all depends on the work from home and so forth. But anyway, this year will still be a stronger than normal year. The first reason is, of course, in terms of the current trend of consumption, everyone is consuming more at home, cooking more at home. The other reason is with the international border closures, there'll be the number of households, I guess, stuck in Singapore will be higher, and this kind of helps consumption patterns for groceries. The unknown, which even the management admits, is that is the change in consumer behavior. I think post-COVID, what is unknown is how much more will be cooked at home and so forth. Obviously now it's elevated, but post that, I think even nobody can truly tell what will be the trend like in terms of cooking at home and so forth post-COVID. For us, we may upgrade to accumulate because of the share price partly weakened, but our target price is unchanged. So anyway, the merits is, they still have like strong cash, strong balance sheet, 26% ROE, and the dividend yield of 3%. We pegged our target price just to a 5-year average. Next slide. In terms of ventures results for the 4th quarter results, the title basically there were 2 new growth drivers identified by them. Next slide. In terms of the results, the comments were actually quite blank because they hardly say much in the results, as we all know. But anyway, in terms of the positives, the margins was stable. And this is commendable because the revenue, as you can see, was down 11% year on year. And usually when revenue down, you usually get a negative operating leverage. But this time around, because of the better product mix, and also they kind of managed to cut staff and other operating expenses. The other positive, I think somewhat similar to Sheng Siong, is also the cash just spiked up. Even though the revenue earnings was weaker, but the cash, they jumped to a record 900. I think eventually they're going to hit $1 billion of net cash. And of course, due to the positive working capital. In terms of the negatives, the weakness for us was the revenue. I think with the whole tech sector reviving so strongly, but their revenue was quite sluggish. I think quarter on quarter, it only rose 1%, which was surprising because 4th quarter is supposed to be stronger. And usually in the 4th quarter, in the 2019 and 2018 4th quarter, quarter on quarter, usually jumps about 12%. This time was only 1%. So it's a bit weak. And they don't give details, but what they kind of alluded to was that there was a weaker point of sales. I think point of sales is quite a big revenue generator, I guess, for them. The point of sales, just for those who don't know, is that you go to the restaurants or retail outlets, that the point of sales that take the cashier in the cashier counter. So because of the sluggish retail environment, there's a reduced need, obviously, for such terminals. And also on the flip side, they did mention that demand for ventilators and diagnostic equipment actually did well for them. such as the PCR testing and so on. In terms of the outlook, 2021 should be a strong year because 2020, just to refresh, 2020 was supply disrupted. Because when the MCO hit in Malaysia, because they have a huge manufacturing presence in Malaysia, so that kind of hurt that kind of affected their production in 2020. So number one, so that should help them in 2021. Of course, the second part will be the stronger global growth, and that will help everybody, I guess. But the issue for them has been the ability to kind of break their FY17, FY18 record earnings. So, but for that, they mentioned that they are laying the groundwork for the next 10 years. So for them, they're going to target new product categories. Some of it is basically EV batteries, electric vehicle batteries, wafer fab modules, basically the front-end equipment used by TSMC and so forth. And of course, gene sequencing equipment. The one caveat for that is that these are quite new products, so it might take some time for it to ramp, but they've identified these are the key areas. I think they were pretty excited about the EV in China. I think there's a huge the growth for that is multi-year, so they're definitely going to target that, and they probably need to expand their presence, especially in China. So for us, we maintain neutral. I think our target price is higher, but what we did was we just again, we usually just use a 5-year historical average, 16 times PE. So that's how we got to $19.20. And they got a yield of 4%. So, I mean, it's still quite a reasonably attractive stock if you want to just buy it, because you're going to get paid 4% as you bid for all these new products and new initiatives that they're working on to ramp up. Next slide. Okay, in terms of Propnex, I think we just give you the title because the numbers speak for itself, I guess, because they got 33% ROE and their dividend yield is almost 7%. Next slide. So for Propnex, the positive this time was actually the resale. So as you can see from the table, resale revenue was the main driver. The numbers just grew, just surged. I think the resale 51% revenue. So resale revenue recovered sharply. I think if you recall, in early 2020 and even post-pandemic, we were quite worried about the resale revenue because there was quite a large gap in pricing, and also because of the pandemic, there was inability for people to go visit, to go around looking at units. But this time around, it helped recover, and also HDB resale was strong, and this was expected because of the huge grants that were given by the government for resale. If you buy a resale unit, I think you get additional 40,000, 50,000, around those numbers. I totally still remember the exact figure. And the other reason the private residential resale is recovering, is because of the view as a large price discount compared to the newly launched units. Again, the other positive, I think, similar to all the two other companies, the cash keeps piling up. So for them, their cash flow surged to 105 million, considering their market cap is only 300 plus million. So this 100 million is a huge number for a small cap. And the dividend jumped about 57%. Important to note that the yield that they're giving, that 7% or 5.5 cents, is based on the 20 million kind of cash payout. And they can I think they can push this, they can even double it if they wanted to 10 cents. Because you got 100 million of cash. But for them, they've always said that an important metric for them is to ensure that Propnex is a dividend-paying stock. So I think there's a chance that they will keep maintaining a 7% yield, because there's a huge amount of cash. They 20 million payout, and they generate about 40 million, let's say 30-40 million of operating cash flow a year, and also they got 100 million, so they can maintain a high dividend payout. The other thing is just an impairment of associate, but that's quite a small number. In terms of the outlook, resale, of course, will still be strong. HDB. New launches will be a bit softer because they mentioned there'll be a slowdown in new launches. So I don't think it will contract, but the growth rate won't be as spectacular. Okay, in terms of the cooling measures, for them, I think we'll just run through the numbers for you. Okay, in terms of the cooling measures, if you recall, the last time we had a cooling measures and everyone, as you remember, everyone quickly rushed to go and buy a unit in over 24 hours was in July, and the index actually rose 9% over 12 months. That means up to June of 2018. So sorry, it's a lot of numbers here, but up to June 2018. So index rose 9% over 12 months, and that's where the authorities reacted. So in comparison now, as of up to December, the past 12 months, the index is only up about 2%. And also from third quarter, it's up about 5%. So to hit that so-called 9%, I mean, not a magical number, but you just use that as a benchmark, over 12 months, the index need to climb another 6% over the next 6 months, which is what the Propnex management also kind of agree that if the price index keeps on rising, especially the next 6 months by another 5 or 6%, then there is a risk the authorities will come in. Of course, we're not seeing it, but there's something to just monitor. If you want more details, anyway, they'll be doing a webinar with us tomorrow. Okay, for us, we maintain a buy. They got a yield of 6%, backed by strong cash flow, 3% ROE, and then and also they have got a 53% market share of all the residential property transactions, HDB and also private. Next slide. Okay, our usual Singapore weekly. Next slide. Okay, in terms of Singapore numbers, the macro numbers are still strong. You can see the industrial production is up 5%, but do note this is quite a volatile number. So, but you notice that electronics was especially strong, 20%, and those numbers are much more stable than pharma, which is like up and down. In terms of the banking loans, I think Wee Kong will probably give you more on our banking monthly, but there was a slight improvement in the loans growth in Singapore banks. A slight improvement, this means contract less, anyway, by the way, because December contracted 2, then this year they contracted 1. Consumer loans driving it. In terms of the US data, of course, now the most important number everyone's watching is the inflation number, and of course the core PCE is the key one. Just consider it like a core CPI or core inflation. So that is about 1.53, and it's still below the. Just to refresh, the Federal Reserve has a goal of 2%, and it has to be more than 2% for some time. Don't ask me what is sometimes. Nobody really knows. They never really spell out. But so 1.53 is still far behind. We have a chart later. Other news, we all know there's the 1.9 million stimulus going to the Senate, and there was some commentary by Powell. The economy is still a long way from employment and their inflation goals. And important to note is that they're not looking at the forecast. They're looking at the actual number hitting their employment inflation targets. Okay, anyway, into our tactical views, I think we feel that the market might be a bit overreacting in terms of the market seems to be repricing, tightening far faster than what even the Federal Reserve expects. Of course, the debate is whether are we overheating or recovery, but that one is still not clear. But for us, we think that it's just the interest rates are now returning, the 10-year yields are just returning back to the pre-COVID levels, and we are still positive on the market. For us, in terms of the event, I think the events you can see, but in terms of the poems events, we will have Propnex, and we have I think 3 listed companies for this week. If anyone is interested, just go into our poems website. Next slide. The pandemic, again, we just refreshed this, and the reason why we do this is the pandemic will also determine the trajectory of the recovery. If pandemic levels are high, then the recovery will be slower. So you can see that cases are now back to 4-month low, and they're contracting fast. So globally, they're contracting almost at 40% month on month. So that's good, and especially when the vaccination is not fully rolled out yet. Next slide. For Singapore, the cases, the community cases are still there. I think every week we look at this number. So last week there was only 1 in community case in the past 1 week, but right now we have hit 4. So we are not totally out of it yet. And of course, the government also mentioned that we are not exiting phase 3 anytime soon. I think just as a note, the thing is for them, they're still not sure whether the vaccine can prevent viral transmission. So what that means is that even you get vaccinated, doesn't mean you cannot spread it. So I think there's something that they're watching the science around it. Next slide. Okay, anyway, this is the PCE. I mean, sorry to bore everyone if you're not interested, but this is the red line is to the Fed target. So what it means is that it has to cross the red line and then it has to cross for some time. So what we did was we used the orange line, which is a 12-month moving average, so that we know that the long-term trend is that the inflation is above 2, and you can see it hardly crosses 2. So we are still far from it. So it's something to watch, but nothing to be alarmed. I think inflation will rise, obviously, but we still need to watch it crossing 2%. And so far, you can see it crosses, but for only a short period of time during 2018. And the Fed is watching more on employment, hoping that it goes back to about 4%. I think now it's, if I'm not mistaken, 6 or 8. Next slide. Okay, this is our final slide. This is our update. Every month end, we will update on our model portfolio. It wasn't a good performance for us. I think we got hit by 3 things. We got hit by the REITs. As you can see, all the REITs had negative performance. Lack of banks also hurt us. I think the banks this month were up about 6%. So not having banks don't hurt us. And of course, our presence in Yoma also hurt us. That was a big whack, about 35%. In terms of the sectors that did well in the month of February, I think finance did well. I think, like you mentioned, banks. I think most of the banks hit like 6% returns. Transportation did very well. I think you can see from there, SIA up 21, SETS up 14, SPH is up. This is just for your reference. And what was weak was at the bottom there. Some of the big losers were like Micromechanics, UMS, and some of the REITs especially were also were hit quite badly. This is our performance. So we are actually 11 percentage points below. Again, we just do it for transparency. We don't hide all these things. If we underperform, we underperform. I think this should be the last slide. Next. Okay. Thank you everyone for taking the time. And we will feel free to post your questions, and we will try our best to address them.
Okay, I think I'll take the first question. I think it's on OCBC. I think yeah, some people just wanted to ask me to justify, a 40% increase in my target price from $9.68 to $13.65. Okay, just let me go back to my slide on OCBC. Sorry. So maybe. Okay, so for OCBC, actually, previously our target price, because previously the cost of equity that we were forecasting, the return on equity that we were forecasting was much lower, at about 8.5%. And also basically, if you look at what OCBC is trading at, it's trading at about 1 times of their book value. And previously, because of our ROE assumption, our target price to book value was at about 0.9 times. So a lot of it is that target price to book value actually shifted quite a bit from 0.92 to 1.19. Of course, we see that apart from the fact that ROE improved, we also changed all our banking parameters in terms of the model. So our cost of equity actually changed as well, and that gave rise to about a part of the valuation increase as well. And if you take a look at historically, their trading price to book value, it is at about 1.1 to 1.2 times at the higher end. So we think this price to book value premium is also justified. If you take a look at compared to DBS as well, DBS is trading at about 1.3 times of their price to book value. And also our DBS target price was also raised by about 30%. I think generally what happened was that once we remove all these excessive provisions that they had faced in 2020, and we are likely to see all their ROE start improving. So this will give a very good valuation upside. Yeah. Hopefully that answers the question. Okay, sorry. Okay, let me see whether there's any other banking question. I'll just take all of them at the same time. Let's see. Just taking a look whether there's any banking questions. I think that's it for the banking side. For the Q&A part, maybe someone else would like to take over. I'll take a look at the chat. Yeah, I don't see any banking other questions. Maybe someone want to take the remaining questions out there.
Yeah, I'll take this. What is the outlook for glove companies? Why their share prices keep dropping despite the good results? Okay, and me, there was a Riverstone briefing recently. I didn't share because we just had too many things, but the message that is that the prices the selling prices continue to rise for gloves. So quarter on quarter, you should still see a strong quarter on quarter results. The reason is dropping is just the unknown. I think the worry is that post COVID, the number of gloves will just collapse. We don't agree with that, but it's a big uncertainty. I mean, no glove maker can tell you what will be the trend line growth, the trend line of gloves post COVID. So I think market is just pricing in a collapse, or pricing in that unknown for the weakness in gloves. We are still positive on it because, like I said, our forecast is based on not on this year's super earnings, it's post-COVID. But I do share some of the sentiment. I mean, I do agree that this big unknown is the one that's causing the market to be a bit more skittish and just selling down, and the momentum is dropping. I mean, the current PE is now about 3 times two. I think UG is probably hitting like 4 times, or even 5 times. But I think it will be hard to address that because that is the big unknown, and we might have to go through this process before the market kind of believes that the glove demand is sustainable. Even pre-COVID, glove demand was already rising 10%. So we are still optimistic that the demand will still be strong. But again, it's not going to be easy to convince the market that that's what's happening. But you can still expect strong quarter-on-quarter earnings. I think Riverstone already said that the prices continue to rise even into January or February. I hope that helps.
Yeah, I'll just take over from there. I think there's 2 questions on UOB. I haven't released the report on UOB yet, and so within, I think for now I don't have a new revised target price yet. And as for which bank that I would prefer within the sector, I think also we will need to wait until the UOB report is out after I take a look at everything, and I will talk about it in the next Banking Monthly, which should be out which will be included in the webinar next week. I think between OCBC and DBS that I have already released, what I'm currently preferring is for OCBC over DBS, because I think OCBC, their excessive capital that they have really is a very strong upside to a possible increase in dividend. I'm not sure whether this the bank itself has also said that this is not a good value of CET1 level that they're maintaining. Is a bit too high. It's not very efficient. So what they are trying to contemplate is to rationalize whether they want to increase their dividend faster or room for dividend growth in the future, or they give out a special dividend. But of course, they are not that willing to give a special dividend because this is a one-off thing, and then next time in the future, it might dampen their room for growth and what they are contemplating. Yeah, so this is something that I think is a possible upside for them. And we take a look at a capital ratio of 15.2% compared to DBS. DBS is currently, I think, 13.7, 13 point, yeah. So it's slightly lower. Yeah, so between the two, I'm favoring OCBC. Yeah.
Hi, good morning, everyone. I would like to take the question on ERE logos. I saw it for, okay. So I think the question is sell or hold. So first of all, we don't have coverage for ERE logos. That said, I think based on their FY20 results, they actually outperformed a lot of the analysts' expectations. Basically, they improved their occupancy by about 3%, and they managed to secure positive rental reversions. I think one of the most of the reversions were driven by a lease renewal to Schenker, which is their second largest tenant. And so basically the revenue went up also in part due to this. Last year, they announced a significant acquisition. So basically, it was five logistic assets in Australia. 5 of them will be wholly owned, and then after that, 4 assets will have a 49.5% stake as well as a 40% stake in the remaining last asset. That brings the total assets to 10. So I think being a logistics pure play, or rather being very focused in the logistics sector, this is a sector that will definitely benefit from the e-commerce trend. Not to mention their expansion. I mean, with their new sponsor, which is Logos. So they have a pipeline to continue acquiring and growing. So that said, Australia is also a country where e-commerce is the e-commerce penetration rate is actually relatively high. Yeah, so I think overall the outlook for ARA looks good, but we would not want to comment on whether or not you should buy or hold it. Yeah, so that's for ARA Logos. I saw another question, CK. Your question is on is about Prime, but I will just take it. Okay, so the question here is Prime US has reported a committed occupancy of 92.4% for its latest results, but the actual physical occupancy at the office remains at about 20% amidst ongoing work from home arrangements. So CK also goes on to say that this matter was disclosed by the CEO and CIO, and also if this is a problem. So to answer this question, I think given that most of the assets, all of Prime's assets are actually located in the US. As we know, the US is still struggling trying to bring down their case counts and to keep it at a low level. So because of that, I think a lot of companies are still adopting a predominantly work from home arrangement. So this is not the lower physical occupancy is not really a surprise there. If you recall, when Singapore was in their circuit breaker period, everyone had to stay at home and work from home or telecommute wherever possible. So at that time, during CB, the physical occupancies in the Singapore office assets were also around 15 to 20%. So this is not really an indication on whether or not. I mean, I guess in a sense, the more important metric here is that the rent collections, meaning to say that the tenants are still being relatively current with their rents, high collection rates of 91%. So I think that matters. As well as I think in the longer term, the concern may be whether or not the companies will actually want to reduce their space requirements and adopt a more hybrid or work from home centric kind of work arrangement. Yeah, so basically that is in general how the office sector is doing. Jie-Hui, if you have any other comments on Prime and you would like to chip in.
Yeah, thanks, Ned. So as in like what Ned mentioned just now, so we don't really see it as an issue. Yeah, as in given the current COVID situation in the US, it's actually no surprise that many companies are really still working from home. And yeah, as Ned mentioned also, rent collection is still high at 99%, with minimal deferrals granted to tenants. Therefore, you can see that the income stream is actually still rather resilient. I think just to add on, the expiries are minimal in FY21 and 22. I think 8% for both years, which brings additional comfort if you're worrying about the work from home phenomena. So just to give you some context also, in the US there's typically no break clauses. So tenants will need to pay their leases in full even if they break their leases early. Therefore, as in it's more likely that tenants will stay on throughout till the next time they have to renew their leases. And then maybe one last point is in terms of supply. So even though offices are shifting towards a hybrid work model, Prime's assets are actually in markets where upcoming supply will be limited in the next 2 years. So except for Salt Lake City, which pre-leasing has only just begun, the bulk of the upcoming supply has already been pre-leased. So yeah, and I think to add on to that, most of Prime's markets are actually forecasted to benefit from positive rental growth in the next 12 months. Yeah, so just to conclude, we still remain positive on Prime and its assets. Yeah, so this is all from me.
Hi, I think I will, there's one question on Koufu. So I will just read out the question and then yeah, I'll answer. So referring to your comments for Koufu, what are your views for related counter Kimlee? Does the same issues relate to Koufu similar to Kimlee? So I think their business is largely similar. The key differences for Koufu and Kimlee is that for Koufu, they have operations in Macau versus Kimlee, which is more Singapore dominated. Koufu also, that's the first thing. The second thing is also Koufu have more of their food courts located at the some of the tertiary institutions, office spaces, and also even at Marina Bay Sands, versus Kimlee, which is predominantly in the heartland areas and also in the industrial building. So comparatively, Kimlee's business is more resilient now because it's more Singapore centric versus Koufu, where you have operations in Southeast Asia and Macau. And also the business is more resilient because your businesses, most of the coffee shops for Kimlee is located in industrial buildings like what we see. So the issues plaguing Koufu at the moment is not similar to Kimlee, and so consequently Kimlee is more resilient. I don't know if I answered your question, but if I didn't, just let me know. Yeah, thank you.
Okay, maybe I can take on some Yuma questions. So I'll just read through them all because I'll answer them together. I think first of all, any update from Yuma management on the intensified Myanmar situation, any profit guidance, and what are the likely developments? Secondly, what is the impact on Yuma's revenue, year-on-year percentage, if there is lower Myanmar FDI and also prolonged confrontation similar to Hong Kong? And I think one last part is what is the recommendation for Yuma now, whole or cut loss? Okay, so just to answer them all, I think as I mentioned over the past couple of weeks, Myanmar's political situation actually escalated very, very quickly from like peaceful protests to like flares of violence. And for the Sunday that just passed, I think if you all read the news, protesters are fighting back. The military has been using more force and violence on the protesters, apart from using tear gas and warning shots. So actually now, I think 18 people or might be more than that are now killed in the bloodiest violence since the military actually seized power 1 month ago. In terms of developments, it's likely that we will see more sanctions on from more countries on those behind the coup. We do not have the year-on-year percentage reduction on Yuma's revenue for lower Myanmar FDI and prolonged confrontation. But as of 5th February, in light of the COVID-19 situation, we also trimmed our growth forecast for Yuma's business lines for FY21 and 22. We actually trim it from 5 to 7% to 0 to 2%. Yeah, and I think overall we actually cut our earnings by 27% and 35% respectively for the 2 years. Given that it's likely that the protests will continue and we also will see lower Myanmar FDI, we are looking at possibly slower or even negative growth in the country. We haven't heard back from Yuma's management on the Myanmar situation yet. Therefore, there's no profit guidance. But I believe that they will be providing trading updates for the quarter ended 31st December, which is last quarter. So we are also waiting for that as well. Yeah. Our recommendation as of 5th February was a buy. But as I mentioned, the situation really escalated very, very quickly since then. So you might want to break it. You might want to see if as in yeah, you might want to see if it's time to cut loss depending on how your sorry, how's your depending on how's your risk preference for this counter. Yeah, so this is all for me.
Yeah, I'll just try and run through some of the. I'll get back to you on the SPH. I'm just looking through my past slides. In terms of the other question is, after this one-off gain, are glove companies a growth or dividend play? Actually, that's a very good way to frame it. This is like a one-off gain, but we still see them as a growth. Dividend yield won't be that high. I think even for Riverstone, the dividend yield is 5. UG hardly pays dividend; they need the money to grow. So we'll still see them as a growth stock, and we will still see them as cheap growth stocks post this. Right, I mean, this is a good way to frame it. One-off gain in 2021, but as FY 2021. But again, this gain can carry on because the demand for gloves will remain, and the difference now, the parallel shift is that the behavior has changed. I think the health awareness will remain elevated post-COVID. But the challenge for us is, of course, how elevated. No one knows, because it's talking about the behavioral change, but it will still be higher. And you already see this in some of the emerging market demand. The demand for gloves, the biggest one will be, of course, China. The quality and the type of gloves that they want has seen a big jump. They no longer want the cheapest; they want the better quality one. So all this will improve, but to model out a number that is in a way almost impossible, because there's too many unknowns, and that's probably why it's hurting the market. But for us, we still see this as a growth sector, and where the Malaysian producers are the most competitive, because their capacities are in the billions, and it's very hard to compete against them. I'll get back on the SPH. Let me just look through my other slides. There was one question, a very, very early question, so that's why I can remember. There's one thing, Paul, any SGX listed stocks on EV play, example, car maker, battery infrastructure. So far, most are based in Hong Kong, China. I think to buy EVs, you really have to go outside Singapore. There isn't really any pure plays. But I do I don't remember driving 2 EVs in Singapore. I think one was Miyoshi. I know Miyoshi, the SGX listed, had an associate stake in EV, and then I think we did a spin on it, a dry spin, and the other one was GP batteries. But again, their presence in EV is not as meaningful. If you want a pure play, I think just go to Hong Kong, China, or even the US. I think that would be the better way to play EV than try to find something in Singapore. So far, we are not that I'm aware of any pure EV players. Thanks. Wei Ren, can you ultimately can you help on the credit bureau if you heard anything, because you were in the briefing, I think. If you want more details on credit bureau, they'll also be presenting in a webinar. You can also register for that. And Wei Ren, can you do some first? Let me try to go and get the answers for that question. There's another question. Under the SIA stables consisting of SIA Engineering, and SETS, what is your view with regards to the investment merits within the next 6 months? Kindly place them in descending order of your personal preference. Do note that SIA, the rally in SIA, sometimes almost like no real investment rationale you think of it, because the market cap of SIA now is about 15 billion. Pre-COVID, it was 10 billion. So on paper, the market cap actually increased as a result of the pandemic, and you know how damaged the balance sheet is. So I think the recovery obviously kind of masks the underlying fundamentals. But if you're going to play the trend of recovery and just play on the momentum, then the best is just to buy on SIA. My second will be on Sia Engineering, because pre-pandemic there's always a potential for SIA. I mean, not now because of the damaged balance sheet, to take them private, because on paper they've really got such a huge stake, and you know, there are plans to kind of behind the plans, the owners, I think we know who wants to like globalize a lot of these businesses. So it makes sense to kind of acquire Sia Engineering and then just merge it with at the ST Engineering side. So that would be my second. For sets, my worry for sets is always the valuations is pre-pandemic. The valuations have always been like 20 over times, and it's already maybe 10% below the pre-pandemic price of $5. So I think assets priced in quite a lot of the recovery, even though the results are so bad. By the way, we dropped coverage of sets. Just too many stocks to cover. To cover, but that would be my preference. I think just SIA for the momentum. But again, there's no real, in my own lens, I mean, there's no real true fundamental value when your market cap can be larger than pre-pandemic levels. I hope that helps. Again, we don't cover all this. I'm just speaking of just whatever tip this can.
I would like to take the question on Capital DC. So actually, this is a two-part question. First part is for AEM. Second part is for Capital DC REIT. So what is your view? Okay, so for Capital DC, the most recent target price is actually $3.20. And currently, market price is $2.90, if I'm not wrong. So basically, there's still quite a bit of upside to our target price. And we recently in our last report, we upgraded Capital DC, I think largely driven by the shift towards more technology, future-centric growth in the future as well. So basically, in our view, that is like a re-rating for Capital DC. So just as a refresher, Capital DC, most of the, about 70% of the revenue is actually derived from Singapore, and these are co-location assets. And even though Singapore is faced with sort of a data center moratorium, which actually prevents or limits the new supply of data centers in Singapore, this actually doesn't really affect Capital DC. They are looking more overseas, and in Singapore, they have still managed to create value, unlock value within their Singapore portfolio. So they have conducted several AEIs. Some of them were to bring on more power into their assets, and allow better rents, and basically renting out more space. Some other AEIs they have conducted include converting non-DC space to DC space, and also recall that they actually acquired One Net North, which is actually called DC1. This asset is largely leased to MediaCorp, and about five floors of it was actually shell and core space. So they actually 6 floors was shell and core space. So they actually converted one more additional floor to fully fitted, and they were able to charge fees for the management of this fully fitted space. So in that sense, we still think that largely because of the importance of technology and cloud, 5G, this is a re-rating for Capital DC, and we still feel quite strongly about positively for Capital DC. Yeah, and currently still presents quite a good upside. So that is all for Capital DC. I'm not sure if Paul wants to take AEM.
Yeah, AEM, I have to skip it. Like I said, I always listen to their results briefing, and I totally don't understand anything. So that's why I can't say anything on AEM. Yeah, I think sorry, I can't really help much on the AEM.
Hi, Paul.
Yeah, go ahead.
Okay, so pardon me for my late reply. So for now, I will do the technicals. So due to time constraint, I'll just go through some of them. So just give me a moment. Okay, so Yeah. Okay. So the first one will be the actually SPH SIA, but I will do CCIT first. I'll do Mr. Wu first one. Then after that I'll go SPH and SIA. All right. So for CICT, although I did call a sell after it breaks $2.10, I think a few weeks ago, but prices still I think it breaks out of the falling wedge. But I think prices long term wise, I'm still aiming to buy over here to target. First of all, is we are completing the C wave of the 5-way triangle. So this will be D, and then after that it will be E. So the next selling price actually at 2.47 will be the next crucial resistance zone in the long run. All right. So anytime I think that in order to confirm the upside, I think $2.20 needs to be broken. All right, and then followed by 240. Okay, that's for CCIT. Then I go to Ascenders. So Ascenders wise, I think it has broken the support and resistance zone. I think last week. But prices, I think is going to trend below to trend towards $2.81 to $2.70 with support zone to test for rebound. All right, anything I think for now we just approach and wait and hold attitude for now. All right. So the next one is COTT. So Escort, right? Escort, right now I'm quite neutral for it. Let me take out this. So, but I'm long-term support zone between 0.865, 0.895 will be the likely price target for now. As I noticed that there is a small bearish flag occurring. So if you may take this as an immediate support, 0.96, most likely it will be invalidated. And should this be invalidated, then we will look for the support zone to accumulate at 0.865 to 0.895. All right, so I'll move on to SIA. So for SIA, it breaks at a new high. I think if you read my report, I think published on together with stats, I think SIA has really hit my first target price. I think second target price, I can't remember. I think is at 0.549 or $6. I can't remember. I need to check back on my report. But as of now, I think that the first target price has been met for now. If you look at this is the fractal version. So this is the larger, smaller, and then the smallest one. All right. But you look at the Ichimoku, I think is trending very strongly. So I think for now, I think target wise, I think 550 is the immediate target. Before that, and then breaking it, we'll see prices trending in midterm trending to $6. Okay. So next one is SPH. Okay, I think SPH has a very good run up last week, but this week I think it get lower. But fret not. But if 1.31 is managed to close by the end of this week, then we can see that renew upside again. But do take note of the resistance at 1.52 to 1.58. Then that will be the resistance zone to look out for. All right. Okay. So yeah. Thank you. SI done. Okay. So the next one will be Yang Zhejiang, UOB, and MedTech. Oh, that's a lot. Okay, so Yang Zhejiang for now. Okay, Yang Zhejiang for now, I think is slowly approaching my resistance zone. So to take note, I think for the past few, as long as the price 1.13 to 1.16 has not been broken or reversed strongly, I think I still maintain my view for the past over like maybe a few months, which you have been asking. All right, and then next one is UOB. UOB, I think UOB today. Okay, UOB. All right, testing resistance zone 2, which is quite on a pace to reach my target price based on the recent report on UOB. Okay, so like last week I mentioned that this multiple testing is weakened with a flag. So I expect this 25.22 to 24.69 to have some reaction. All right, or even higher at $26. All right, so this is what my view for UOB. Same for the rest of the banks. I think DBS, I'll do a DBS for now. Because DBS, I think still below the head. So we still are not out of the threat of the head and shoulder. But we can say that the head and shoulder, the neckline is not broken, the support zone is not broken. So we tend to find that DBS has slightly higher chance to trend higher to $28. And then if $28 is broken, I think my long-term target is still within $30. It just that depends that it is having a correction to a rebound at this nearest support zone at 22 to 23.55 before a rebound up to 30 or 30 and then correction back to the support zone. All right, so these are my views. Okay, you can take a look at weekly chart. Yep. Okay, so I move on to the next one. Then MedTech, I'll do MedTech, Riverstone and MedTech, I'll do MedTech. All right. Okay, then I'll skip GLD. So sorry because we are running out of time. MedTech 546. So MedTech, ultimately is still facing tough resistance within resistance zone 1 between $1.10 to $1.20. Okay, so today there's a huge sell down. Like I think UG Healthcare also have sell down today. And then if this support is being broken, I think we are looking at long-term support at 0.49 to 0.62 before it rebound and break this. All right. Since it's been tested many times, okay, support zone is weakened, but and then it definitely will break some days because it's weakened resistance. So, but I will tend to believe that there will be a deeper correction to the support at 0.49 to 0.62. All right. Okay, so I'm done. Okay, I think no further question on the technical, so I pass back my time to the colleague. Thank you.
Okay, let me try to answer some here. Sorry that it's quite everywhere. Can you advise, let me just take the corporate ones. Can you advise the current micromechanics situation as price is dropping rather drastically? Is it still worthwhile to accumulate? I think it's still worthwhile to accumulate our own view. I mean my view. I'm just looking at the dividend yield. I think the dividend yield, if not at these prices, probably could be like 5-6%, if not mistaken. And the reason why it's correcting is, you know, this stock, the volume isn't that high, and also the stock shot up almost 30% in 1 month, 20-30% I think in 1 month, if I'm not mistaken. Sorry if the numbers are not that precise. I'm just recalling from the chart. So that is why it's just correcting, but the outlook is still good. And the one difference from the prior cycle is, as highlighted before, they have a new customer. It's quite strange because this new customer now, because of the huge demand in wafer fab equipment, so we see like Venture saying they got a new wafer fab equipment customer. Micronics also having new wafer fab equipment customer. In part because a few weeks ago we highlighted that the TSMC ramped up their capital expenditure, so there's a huge demand for front-end equipment manufacturing. A front-end basically means those used by wafer fab or used by our old chartered semiconductor. Sorry for those who may not totally understand. So the demand is still good, and Micromechanics, one of those very few semiconductor companies that give you quite a high dividends. I'm just trying to get the exact number. Let me double check on the exact, but I think should be at least 5 to 6 dividend yield. So you're getting paid as you ride the cycles. Quite rare to get this kind of stock. I think it's about 5% yield right now. There was another question on Propnex because it came in early. So let me try to address this. There was one. I would like to join the Propnex webinar. It's on our Poems web page. You just scroll down to the date, to the second, to the second of March. APAC Realty is getting lower, which is a contrast to Propnex. Is Propnex a better stock to hold pure dividend? Yeah, for us, when we decide on what stocks, it's always better, at least our view, I mean, rightly or wrongly, it's just to buy the leader. So Propnex is clearly the leader. And of course, we also like the better balance sheet. I think Apex model is also similar. They're very high cash generative, but I think they bought a building, whereas compared to Propnex, they just kept the cash and just give it out as dividends. So that would be one noticeable difference. Yeah, I hope that answers the question. Okay, for Propnex, your target price of $1, have you factored in the possibility of cooling? If not, then what would your target price be? We didn't factor in, but our forecast, if you look at the numbers, we are not very aggressive in our earnings. We are only assuming like a 10% growth or a 12% growth. And if you want to look at on a PE basis, this stock should be, I think, 12 times PE, but that includes the cash. So if you take out the cash 1/3, we probably like 8 times PE. Would it be because it's hard for us to but you are right. I mean, the cooling measure is definitely a risk. A short-term risk, I think they've already weathered one cooling measure. I think 18, the thing went down, then it bounced back again. But it is definitely a risk for not only them, for I guess all property stocks. But we do not factor in because once you factor that in, then people ask you how do you factor that in? How much is it? Then you end up with another round of questioning that is very hard to answer. So that's why we just assume it will be a normal year. That's something that I was also grappling with. How do we factor in? Then you run into another set of problems. So you factor in, then what is that 15% draw? Then it's a bit unfairly punishing them for something that's not happening. Yeah, I hope that answers. Any Oceanus coverage? No. But if there's, but maybe in a few months' time, we'll bring them in for another webinar for everyone to just listen in if you have the time. We did that with them about a few months ago.
Hi everybody. So I saw some of few more technical questions that's being asked. So I think I will just do the Thai BEV. So just give me a moment. Yep. Why not? Okay, so Thai BEV, right? For Thai BEV, you can look at the chart. I think price already has reach my target. I think beyond my target price one, but it fails to reach my target price two. I think this. Let me pull up number 2. Okay, so it hit like 1:1 ratio of the symmetrical triangle, and then price came crashing down. Correction. If you look here, I think it did have some rebound at the support, but do factor in that there's a mini pennant or mini flag. Means that any price that goes on the upside, if it rejects 0.75, I think is poised for a correction. So in the event of the correction, I think I'll look for a support at 0.63 to 0.65 in the future. Okay, so also factor in this, the routing top. Support, major neckline support come resistance is 0.715 region. All right, so less likely is going to break its tested mine time. So I think that if there's a bearish flag, then we will see much of a correction to the downside to this to at least 0.630. All right, hope that answers your question. Okay, then I'll do AEM and then capital DC rates. I have some comments also on the chart, and then I'll pass back to Natalie to do the closing for capital DC after my technical section. All right. So I think AEM has a huge sell down after it complete the 5 wave, which I've shared in the report previously. And hit my target price. Okay, so AEM sell down, although this is like a reversal doji on the downside, but price decided to do a reverse sell off today. Okay, so what are the resistance, what are the support that you can look at is 3.71 to 3.59, and then the deeper support is 3.43 to 3.50. Okay. Okay, so yeah, sorry for miscom. I think Natalie has talked about capital DC, but never mind. I'll just do the chart I find Capital DC much interesting. Okay, so Capital DC, allow me to destroy this. Okay, Capital DC, I think it tested the support, goes up, I think after the result last month. Okay, and then but it fails to clear above, sustain a rally above $3. So hence, I think it hit my first target price 3.02, and then it came on a correction. So effectively, my trade stopped out. Based on the report, I think it's looking for further downside. I think it's going to test the lower bound of the support zone at 2.54. Other than that, if it breaks further, then we will test 2.28, which I hope that it don't go over there. All right. So, but you can see that on the overall on the structure, especially from last year, I think when was this? Okay, let me move away. August all the way to this year. Okay, I think price is still trending on the range type. So what I would suggest is no, really buy low and sell high. That's the thing that I will look out for on that. Okay, so yeah. Okay, so UMS AEM has done. UMS is roughly the same. So yeah, okay, so Yang Zijiang and done. GSY culture, I check not much of the data that I can put it out. So yeah, so apologies for that. Maybe I'll do VIC. Okay, so let time check. Okay, so for 569, the counter. It's really much on a ranging after it breaks out on the downtrend, after it actually breaks off the falling wedge, which is kind of a reversal pattern, but especially after since it complete the 5-wave upside. But since price is still within the range, so therefore I think that the momentum is kind of weakening for 569. Okay, so right now not much of a trade action that I can recommend or see going forward. Okay, so I think my technicals are quite like done for now. So I'll pass my time back to my colleagues. Maybe Paul.
Yeah, okay, I'll try and address this very quickly. We will try and take it on more next year, but this question is the effect of inflation on stock market. What happens if there's a high joblessness with pure inflation? Will Fed be forced to increase interest rates higher, tighten policy? Are those selling treasuries, are they moving into equities, and why is gold prices also falling? Okay, anyway, on when we have high inflation and also like high joblessness, I think we end up becoming like Venezuela. I'm just kidding, but anyway, it basically stagflation. Basically, you got high inflation and then you got very weak growth. So that's the worst. I think the whole market will collapse. Hopefully not touch wood. And then the 2% effect of 2.5, it will be bad, because what it will mean is that if inflation hits 2.5, then it might force the hand of the Fed to prematurely raise rates, because expectations now raise interest rates, because expectations now is for interest rates to only move in 2023, which is more than 2 years. So any move in that will definitely hurt the market, and you can see the market is really kind of narrowing the timeline to tighten. Are they selling treasuries into equities? I think the flows that we see right now. The thing is, we need to get it our own. What we do is we look at the ETF, one way to get a proxy to the flows. A lot of flows actually going into more commodities and emerging markets, because everyone is playing this whole cyclical rebound, cyclical recovery. So emerging markets are the ones that's getting all these flows. We'll try and get all this data for you. I just don't have it offhand. Gold price, gold is like let's consider gold like a zero coupon bond. And I think when interest rates rise, they will get hurt the most. Zero coupon means that like a bond that doesn't pay any interest rate. So of course, when rates rise, they'll get hurt the most, like any long dated bond. I hope that is a bit easier to kind of understand. But we'll try and do one section on that after the results season. Thanks. I'm not sure if I really answered the question. Any others before we kind of... Oh yeah, there's a question on UMS. So let me try to tackle this too. will UMS impact, will the impact on JP and UMS? Okay, what is your view on UMS? Will JP continue to drag UMS down? Okay, UMS, as you know, the results were shit because of write down on JEP. I think their target for JEP is just to break even. I mean, we have a sell call on JEP because of the whole impact on aviation. I don't think there's any demand for aviation parts. There's enough of shit. There's enough of aircraft sitting in the desert, and they're going to order any aircraft. The other thing where maybe people cut back on the expectations for UMS was the effective tax. I know it's a bit of a strange thing, but effective tax for UMS used to be like mid-single digit. I think the expectations now is it could hit to maybe mid-teens or low mid-teens. So that kind of shave off a bit of growth. But we still like, I don't cover, but just from the top down, UMS still looks good because they are targeting the wafer fab business and wafer fab equipment. And you know, there's a big, huge surge in capital expenditure for that. And even their main customer, Applied Materials, is also guiding for a strong year ahead. So I think UMS is still fine. Just that you got this, people maybe cut back a bit on the expectations for UMS. This is my own view, but I think midterm is still looks fine for me. But yeah. Again, no coverage, just our own views. I think we can. Is there any more questions we want to take, or we need to end it for you, is it, Weiren, because you're coming out your meeting?
I think I'll take the last question, Paul.
Okay, sure,
that's an SGX question. Yeah. Okay. So the question is, whether SGX is a good value stock for dividends and moderate growth. Okay. I think there's two main points to this question. I think first of all is that definitely we saw that 2020 was a very good year for SGX itself. They actually saw their trading volumes increase across like derivatives and stocks alike. However, so a lot of people, what they are questioning SGX is whether this extra volume in a special year, 2020, will carry on into 2021. Ultimately, we are seeing is that right now that all the signs are still pointing towards a very heightened trading volumes for SGX, at least in the short to medium term. And what we are seeing is that their expanded business coming in from BitFX, which is their OTC FX trading, as well as a scientific beta, which is supposed to capture all these passive investment trends, like ESG investing. All these will stay, but they are still in the early stages of growth. It might take some time before you see that spike up again from the contribution to these businesses. So it is like a balance. These two growth, whether it will offset, whether we will see any fall in participation, and whether the new growth areas can offset this to overcome the weakness that we might see from the tapering of retail participation for SGX is a very huge factor on whether they will continue to see growth, especially in 2021, coming off a very good year. Personally, I'm confident. I'm confident of what they have built up in terms of their business model. If you take a look at it, it is very, very comprehensive right now. All the asset class, multi-asset class, and the exposure to the various markets is also very high. And so this is something that's good. And if you take a look at in terms of the dividend, of course, dividend is lower compared to the REITs, but it is stable. You can kind of like guarantee an 8 cent per quarter, which is kind of like 3%, slightly higher than 3% yield right now. So definitely it is something that is defensive, if anything, to tide through this maybe a little bit more volatile period in trading. Yep, and that's it from me. If there's nothing else, I think we might have to end this session just so that Weiren can.
Anything. Thanks, everyone.